Richard, thanks for joining us today.
Thank you.
I'd like to get your take on last week's Fed meeting. Fed Chair Ben Bernanke reaffirmed the plan to keep rates near zero, yet 11 of the 17 policymakers suggested that they expected rates to rise to 1% or more by the end of 2014.
Right.
So is the chairman becoming more isolated in his thinking, or as I think the economists called him, a lonesome dove?
That's a good expression for a Texan, by the way. No, I don't think so. It's a committee. There are 17 people on the committee. He chairs the committee, and he's reflecting the consensus of the group. There are outliers. I happen to be one of them, by the way. But the purpose is to have a full-throated discussion. He needs to broker that discussion and then reflect, as he does so well in the press conferences, where the committee comes out, and I think he did a good job.
All right, so as an outlier, just briefly,
a lonesome hawk.
Lonesome hawk, and your opposition.
Right.
Give me a sense of it.
Well, I was against the quantitative easing programs on treasuries, and I have been against what's called Operation Twist. We call it maturity extension program, because what this leads to is a mispricing of government debt. We are trying to assist the employment creation of the country by suppressing interest rates. That's the good news. The bad news is that it then provides misinformation in terms of signaling what is the true price of government debt the longer you go out in the yield curve. So our politicians are not getting the signs. They need to understand how the market reviews their work. We've done a lot in monetary policy. It's fiscal policy that now counts.
We'll get to a little bit more on the fiscal policy issue in a second, but aren't rates simply likely to get adjusted as the economy gets stronger despite the stated plan?
Well, I think this is something that the chairman talked about. In the good program, if things turn out well, as the economy gets stronger, as he said, the cost of money will go up. Interest rates will rise. There's another way interest rates can rise, which is inflation demands more payment in terms of the coupons. I don't see inflation as an issue right now. We do our own calculation in Dallas on what's called the trim mean. I've been saying this for a long time. It's trending towards 2%, which is our long-term target. So if the economy improves, as it improves, you should have greater pressure on interest rates. Or there's a third alternative, which is the market begins to reject the prospect that Congress will actually do something about our long-term economic problems and start pricing debt a little bit more aggressively in terms of interest rates. But right now, as I like to say, we're the best-looking horse in the glue factory. Europe's a lot less attractive than we are. We see flows coming from there into dollars.
And before I move off this subject, is there not a concern of setting up a too far, too fast scenario by holding rates steady for a long time?
You mean that we might hold them too long?
Yeah.
Yeah, this is a concern. What is our exit strategy? We believe we have an exit strategy. Speaking personally, I'm not in favor of doing more because we've never attempted this on this scale before as a central bank. No central bank has attempted this before. So I think we may have painted ourselves in a little bit of a corner. I believe, and my colleagues believe, we have the means to extricate ourselves from that. But as your viewers probably know, I'm not in favor of doing any more. I wasn't in favor of doing what we did. Now we have to see how it plays out.
Let's talk fiscal policy, as you mentioned.
My favorite subject.
Exactly. Chair Bernanke said last week, if no action is taken by the fiscal authorities, the size of the fiscal cliff is such that there's absolutely no chance that the Federal Reserve would be able to have the ability whatsoever to offset that effect on the economy.
Right.
Those are pretty strong words from the chair.
Yes.
How dangerous is a lack of action by Congress, by our fiscal policymakers?
I think he nailed that issue because it is extremely dangerous. They have to act. They have been incapable of balancing a budget, A. B, providing the right incentives, and this is the most important part. We've provided a lot of gasoline for the engine, lots of liquidity. The world is awash in liquidity. The question is, what incentivizes people that hire, private businesses, step on the accelerator, create jobs, move the economy forward? They'll only do it if they have the right tax, regulatory, and other incentives. That's not the province of the central bank. That's the province of the people we elect to make fiscal policy, the senators and the congressmen and the executive.
So you've been fairly candid. I think you called them Congress shamefully negligent of its responsibility.
I call it misfeasance.
Misfeasance. What do you say to them now to encourage some action by the end of the year?
I think you're beginning to see a lot of discussion, but we need action because, as the chairman said, there's no way that monetary policy can supplant their charting the right course. There's two things. reassures the world that long-term we're going to get out of these unfunded liabilities and get out of this path of ever-growing deficits. And secondly, this is important, doing it without driving the economy into recession. So their short-term initiatives have to be sound within a broader strategy of rebalancing and getting things right from a long-term perspective.
What are the odds we get action?
Well, I think at some point they don't have a choice. They have to act. This is what we put them in office for. And as you may know, Willow, I make no difference between Republicans and Democrats. They have dug the deepest hole, and they're burying our children and our great-grandchildren. And unless they figure a way out, no amount of monetary accommodation can assist the problem. And by the way, can make it worse. Because all we're doing is saying, we're delaying the time when they have to take action. Like saying to your children, you and I have young children, I have grandchildren, what we're saying basically is you better eat your vegetables. But if you don't, we have a lot of monetary cookies for you. Go ahead and eat that plate of cookies. We know that's not sound. And I think the chairman was just expressing his frustration, as we all have. Fiscal policy is necessary, otherwise monetary policy does not work.
Another topic in the news, too big to fail. You wrote that downsizing institutions into ones that can be prudently managed and regulated across borders is the appropriate policy response. So how would you go about doing this, ending too big to fail? Where would you start? JP Morgan, send Jamie Dimon off to Tortuga? What would be the plan?
Well, he's free to travel. He's a good guy, by the way. He's free to travel wherever he wants. Actually, tomorrow we're going to
Panda at St. Martin's. I mean, pick your.
Well, tomorrow the Dallas Fed's going to release a slideshow that goes through some of the how-to. There have been pieces this morning in the Wall Street Journal, very good op-ed written by Mr. Stevens, the famous investment banker from Little Rock, Arkansas, very influential human being, a wonderful guy. And he wanted to set strict limits on these large institutions and downsize them. We're seeing a lot of academic papers come forward. And there's a hearing in the Senate Banking Committee, one of their subcommittees, on May 9th on this subject. Paul Volcker's articulated one approach. I've articulated other approaches. But I'm going to ask you to stay tuned because tomorrow the Dallas Fed will post some of the approaches that might be considered.
Do you think more than being a factor in, obviously, the economic crisis that we've survived, this too big to fail issue is a drag on the economy?
Yes, it's a drag on the economy in part because it benefits a small population group that has 52% of all the deposits in America, 5 banks, at the expense of smaller institutions, community banks, regional banks, that are the lenders to small businesses and to communities. And it has burdened them with a regulatory excess that I know, because I talk to these bankers, inhibits their ability to go out and do the kind of business they'd like to do. And there's also an injustice to this. There's a subsidy for the too big to fail banks. And that subsidy, by definition, comes out of the hide of somebody else. It comes out of the hide of the taxpayer, of course, but it comes out of the hide of the community and regional bankers that lend to those that actually create jobs in America. So it's mucking up monetary policy, and our policy becomes less effective because it makes the system so inefficient. We have to do something about it.
Richard Fisher, thanks for your time. Thanks for your wisdom. We appreciate you stopping by today.
Thank you so much.